I'm going to just start talking a little bit about the results then. So it seems that China is at the heart of the concerns for the audience in terms of the major risk, given that, of course, it is the largest country in the region and has huge economic impact on the region and globally. And it seems to be a tie between a slowdown in China and the US-China trade war, which are somewhat connected. So, Stephen, maybe we start with you in terms of what your thoughts are in terms of the question, but also the answers that we've heard from the panel.
Okay, thank you, Cedric. I guess I'm not entirely surprised that China risks feature prominently in the audience list of worries. What I am a little surprised about is just how low the tightening of global financial conditions ranks on this worry list. It's something that certainly keeps me up at night still. As James flagged, notwithstanding a bit of a respite in markets, our own house view for the outlook for the US Fed is certainly a continued tightening cycle. We expect, we thought as recently as December that we'd be in for another 3 rate hikes by the Fed. As James said, maybe it'll, in our next update, be just 2 rate hikes. But the fact is we expect the Fed to continue tightening, and on top of that, the balance sheets of the major global central banks is going to be in tightening mode for the first time since the global financial crisis. So in our 2019 Sovereign Outlook, which is available outside, and I hope everybody picks up a copy, one of the themes for us in 2019 is continued pressure on emerging market currencies and capital flows. So we're in a bit of a respite. Last year we saw these pressures emerge in full force. We saw many central banks around the region deplete their reserves. They ended the year still at comfortable levels. That's why we have stable outlooks across the entire spectrum of our ratings. We certainly would expect in this period of respite and some appreciation of those currencies that they'll take advantage of this time to accumulate and reverse some of that reserve loss. But we do think that the balance of the year we're likely to see a reemergence of some of those market pressures. Now, we do also list in our risk factors for 2019 very much the US-China trade war and the slowing growth in China. You flagged that yesterday the Q4 data for China's GDP came out. It was more or less in line with what we expected. In fact, it was a little better than we expected. We had penciled in growth of 6.3 for the fourth quarter of last year in China. The data showed 6.4. So full year came out at 6.6, which is what we expected. But we expect this slowing trend to continue into 2019. We expect growth to slow to 6.1. We lowered that growth rate because of the US-China trade war. We used to have a growth rate penciled in for China this year of 6.3. We knocked it down early last year to 6.1, specifically to take into account the impact of the trade war. James mentioned that March 2nd is a day to watch out for in the US because of the debt ceiling coming back. I think March 2nd is also the date at which that 90-day window that the US has given for its trade negotiations with China expires. So we have that sort of double witching hour on March 2nd we'll watch out for. So all of these are legitimate risks. The trade war, we've seen the news flow become a little more positive in the last few weeks with that 90-day window and some positive news flow about the discussions that are going on. We get asked all the time what our prediction is for the outcome. The US administration has been so erratic, hard to know who to listen to. There's so much politics involved, but we are bracing ourselves for more escalation in this trade war conflict, hoping for the best, fearing for the worst. As James said, it will have a depressing effect around the region. The likes of Korea, Singapore, Taiwan, to a lesser extent Malaysia, these are the economies with the high share of value added in their output by way of exports to China of intermediate goods that get re-exported to the US. So it will have a depressing growth outlook. But the bottom line I want to flag for the APAC region when it comes to sovereigns is that we have stable outlooks across the board. These risks are very much prominent, are going to cause a general slowdown in growth, but the region has sufficient buffers to weather this, we think, from a rating standpoint. We did have a number of interesting rating actions over the past year. We upgraded Indonesia and the Philippines about a year ago. In the frontier market space, we downgraded very recently Sri Lanka and Pakistan because of specific factors, politics in Sri Lanka, extreme external pressures in Pakistan. On the reverse side, we upgraded earlier last year Vietnam and Mongolia. Vietnam has been an improving structural trend, but Mongolia was really the rebound in commodity prices. We can come back to some of those issues, but after those adjustments, we've got stable outlooks across the region.